Welcome to Revisit Books podcast, where we turn books into bite-sized wisdom you can use every day. Today we're tackling something pretty ambitious, actually. We're digging into Tony Robbins' huge work, Money. Master the Game. It's really like a blueprint, you know?
It really is, built from talking to some of the world's absolute top investors.
Exactly. And our goal, our mission today is to be like locksmiths, maybe.
Yeah.
Taking these really complex strategies, the super wealthy use, and simplifying them.
Making them actionable.
Right. Actionable steps for, hopefully, financial freedom for anyone listening. The stakes feel really high with this stuff because it's not just theory, is it?
Not at all.
It feels like decoding a system. I think JP Morgan's CEO, Mary Callahan Erdoes, she basically said the financial world often seems designed to keep regular people out. We need to cut through that complexity.
That locksmith idea is, spot on. Money is. Well, it's one of the main tools we have to make dreams real, isn't it? College, retirement, just having choices.
Sure.
So you really have to master it. Otherwise, it definitely masters you. And we're trying to look past all the noise online, the strong opinions, the stuff that isn't proven.
Yeah, so much noise.
And just isolate the steps that actually work, the few who really succeed are using, separating fact from, financial fiction.
Okay, so let's start with the book itself. And the author, Tony Robbins.
Oh.
Most people know him for personal transformation, life coaching, that sort of thing.
Mm-hmm.
But when he went into finance, he really went all in.
Mm-hmm.
Spent years interviewing these giants, Ray Dalio, Carl Icahn, Paul Tudor Jones. It wasn't just like his opinions.
No, and that validation is crucial. It's not just self-help talk. You've got Wall Street legends weighing in. Carl Icahn called it extremely interesting and illuminating.
High praise from him.
Absolutely. Steve Forbes said it was a gold mine. And maybe the most relevant part for our listeners, Mark Faber pointed out Robbins' knack for taking really complex institutional knowledge and boiling it down into simple, practical steps anyone can actually use. It's that synthesis, that translation that's so valuable here.
And you get the sense his motivation is really personal, too.
Yeah.
It wasn't just an academic thing. He talks about sleeping in his car, struggling with poverty early on.
Right.
And he credits books for his own transformation. He apparently read over 700 books in 7 years looking for things he could use immediately.
That's incredible commitment. Shows the power of actually applying knowledge, not just consuming it. He wasn't just reading. He was hunting for levers, for things that would make a difference.
He mentioned specific ones, too, right? Like Emerson.
Yeah, Ralph Waldo Emerson's essay on self-reliance, that idea that envy is ignorance, that imitation is suicide, you have to forge your own path. And James Allen's, as a man, thinketh the idea that everything starts with a thought.
You have to believe it first.
Exactly. You need the belief, the mindset, before you can even build the strategy for success.
And then there's that story about Thanksgiving. That seems like a real turning point for him. The giving principle.
Oh, absolutely. He was 11, family had nothing, and a total stranger delivers a Thanksgiving meal. That unexpected kindness, that contribution, it shaped his whole philosophy.
He promised to pay it forward.
He did. By 17, he was already using his janitor earnings to feed 2 families. It connects directly to that core idea, echoing Henry Ward Beecher. Riches aren't the end goal.
They're a tool.
Exactly. An instrument of life. Mastering money is just a means to a much more important end.
So if it's not just about piling up cash, what are we really after? What's the actual goal?
It's the feelings. That's what the book argues. We're chasing the emotions money can unlock. Empowerment, security, freedom, having choices, being able to help people you care about, contribute to causes.
Right.
Money is the vehicle to get those feelings. If you forget that, the whole quest for wealth can become pretty empty pretty fast.
Okay, that makes sense. So let's talk about who this discussion is really for. Who's the ideal listener today?
Well, the book seems aimed squarely at the investor who feels maybe a bit lost, overwhelmed, perhaps bruised by past financial crises.
Yeah, definitely. Yeah. If you're looking at the complexity of modern markets, all the high-tech trading, the algorithms, and you're thinking, how can I possibly compete with that?
Right. I've got a job, a family. How do I navigate this maze? Then this is definitely for you.
And it speaks directly to the retirement situation most people face now, doesn't it? The whole do-it-yourself pension thing.
Oh, absolutely. The 401k system. It's essential for anyone relying on that. Because critics, like Teresa Ghilarducci, she's a retirement security expert, they argued this system has kind of failed people.
How so?
because it expects ordinary individuals, people without investment degrees, without hours to research, without professional tools to somehow get the same results as full-time pros. It's a huge ask.
It's a massive shift in responsibility, isn't it? From the company providing a pension to, you're on your own.
Completely. You're suddenly the captain, navigator, engineer of your own financial ship. You need to get good returns, manage risk, basically be a part-time investment expert.
While doing your actual job.
Exactly. And raising kids and everything else. So the book's promise is to give you that insider's view, to level the playing field a bit.
How does it do that?
By revealing tools and strategies that used to be only for the institutions, the ultra-rich. Things like understanding asymmetric risk-reward, finding bets where the potential upside is huge compared to the downside.
So making those elite strategies accessible.
That's the core idea, democratizing that knowledge, making those tools available no matter your starting point.
Which is what most people need, right? Not another textbook, but a practical map of how the successful players operate.
Precisely.
Okay, let's get into the key takeaways then. What's the first big lesson?
The absolute foundation before any tactics or strategies is emotional fitness. It's your mindset.
Right.
The book hammers this point home. The best strategies in the world are useless, invisible even, if you're not in the right state of mind. Strong, determined, empowered. You have to optimize your psychology first.
Change your story, change your life.
Yeah.
That's the mantra, isn't it?
That's it. We all carry these narratives about money. Maybe it's scarcity, maybe guilt, maybe feeling we don't deserve it. And those stories, often unconsciously, drive our actions way more than any financial plan.
And this isn't just pop psychology. There's science behind this focus on emotional state.
Yeah.
Physiology, even.
Exactly. Think about fear. It's physical, right? Knots in your stomach, tense shoulders. But courage is physical, too. And the amazing part is how quickly you can shift between states.
Like that Harvard study.
Yeah. The power poses research. Just standing or sitting confidently, assertively for 2 minutes, it actually changes your body chemistry.
It raises testosterone, the confidence hormone.
And lowers cortisol, the stress hormone. And the effect was measurable in behavior. People who did the poses were 86% more likely to take a calculated risk afterward.
Wow. Just by changing posture for 2 minutes?
Your body literally primes your brain for confidence. It's not just reflecting your mind, it's influencing it.
Okay, so physiology matters. What else for mindset?
Controlling your focus. Your quality of life often comes down to how much control you feel you have. Financial stress skyrockets when you obsess over things you can't control.
Like the market going up or down. Politics.
Exactly. Or even your kids' attitudes sometimes. Dwelling on the external just breeds frustration. The key is to shift your focus relentlessly to what you can control.
Like improving yourself. Learning new things.
Improving yourself, adding real value, choosing your actions deliberately. That shifts you from feeling like a victim of circumstances to being the creator of your own reality.
And the final piece of this mindset puzzle, the meaning barrier.
Right. The meaning we attach to events determines our emotional reaction. The book uses the example of Julie, a successful screenwriter.
Yeah, I remember that. She kept sabotaging her own success.
Constantly, because deep down, she had this story, this fear about being judged as the 1%, like success was somehow bad or isolating. It was a limiting belief holding her back.
So she had to change that internal narrative.
She had to divorce that story of limitation and marry the story of truth that her wealth came from the value she created for millions. Until you fix that internal story, no financial strategy will stick. You'll just find a way back to your old comfort zone, even if it's broke.
Okay, mindset is foundational. Got it.
Yeah.
Now let's shift to the mechanics, the investment world itself. The book argues it's not exactly a level playing field.
Not at all. Think about casinos. Steve Wynn built his empire on one truth. The house always has an edge. The book argues the mutual fund industry, in many ways, operates like the ultimate casino.
How so? Because they get paid regardless.
Pretty much. They're guaranteed revenue through fees, management fees, expense ratios, whether you, the client, win or lose. This leads straight into one of the biggest myths they sell, the active manager myth.
The idea that smart professionals can consistently beat the market average.
Exactly. The industry spends billions promoting this idea, but the data, it tells a very different, very stark story.
You mentioned Robert Arnott's study.
Yes, a really important one. He looked at 200 top actively managed mutual funds over 15 years. A solid time frame.
And the results.
Brutal simplicity. Out of 200 top funds, only 8 managed to beat the simple Vanguard 500 index fund. 8 out of 200.
That's less than 4%.
Less than 4% odds. And here's the kicker. The tiny handful who win one year, they're almost never the same ones who win the next year. It's not consistent skill for the vast majority.
And the industry hides this with survivorship bias.
Precisely. Bad funds don't just disappear, they get merged into successful ones. Their poor track record gets conveniently erased from the public view. Jack Bogle, Vanguard's founder, had a great analogy.
What was that?
He compared successful active managers to a gorilla flipping a coin 10 times and getting heads every time. It can happen by pure chance in a large enough group, but you wouldn't bet on that gorilla repeating it. It's mostly luck, not repeatable skill.
Okay, so performance is one issue. But there's another conflict most investors don't grasp. The broker versus fiduciary difference. This seems critical.
Absolutely fundamental. People need to understand this. A broker, think of them as a salesperson. Their main duty is to their employer, the brokerage firm. They get paid commissions to sell you products.
Even if there's a cheaper, better product available elsewhere.
Yes. Their incentive is to sell their products. A fiduciary, on the other hand, is legally obligated, like your doctor or lawyer, to put your financial interests first, ahead of their own.
So the conflict in the typical mutual fund world
is that their business model revolves around gathering as many assets as possible and charging fees on those assets. Higher fees mean more profit for them, but directly reduce your returns. The profit motive usually overrides the client's best interest, unless the firm is structured differently, like a nonprofit, perhaps.
like Vanguard or TAOCREFF, as David Swinton pointed out.
Exactly. And then as if that weren't enough, we individual investors often make things worse for ourselves.
Through emotional mistakes.
Classic behavioral finance errors. We chase returns. We see a fund that did great last year, so we pile in, buying high. Then the market drops, we panic, and we sell selling low. We consistently buy high and sell low, undermining our own long-term results.
So looking for a genius fund manager is like chasing unicorns. The takeaway is focus on low-cost index funds.
Pretty much. Own the whole market at a very low cost. Stop trying to find the needle in the haystack.
All right, let's move to the third key takeaway. Compound interest and making saving automatic.
Ah, the magic of compounding. Warren Buffett credits it, along with Lucky Genes and Living in America, for his success. Einstein supposedly called it the eighth wonder of the world.
The most important invention, even.
It's that powerful. And the key ingredient is time. The book uses that classic twin example, William and James.
Right. Explain that one.
Okay, both twins save $4,000 a year, earning a hypothetical 10%. William starts young, age 20, and invests for 20 years, stopping at 40, never adds another penny. James starts later at age 40, but invests for longer, 25 years, until age 65. So James invests more money for more years.
But William ends up with more.
Significantly more. Sometimes 50% more, depending on the exact numbers. Why? Because William's earliest contributions had an extra 20 years to grow and compound on themselves. That early start is incredibly powerful.
It's your biggest advantage, really, starting early. So understanding compounding is one thing, but actually doing the saving consistently, that's the hard part for many.
That's the hurdle, and this is where behavioral economics comes in, specifically Richard Thaler's Save More Tomorrow strategy. It's brilliant because it uses our own inertia for us instead of against us.
How does that work again? You commit now, but the saving only starts later.
Exactly. You agree today to increase your savings contribution, but it only kicks in automatically when you get your next pay raise.
Why is that so effective?
Because of loss aversion. Trying to save today feels like losing money you already have. It hurts. But committing a future raise, that money gets deducted before it ever hits your bank account. You don't feel the loss in the same way.
You never got used to having it.
Precisely. And the results were stunning. They tested this with blue-collar workers who said they couldn't afford to save anything. 5 years and 3 raises later,
What happened?
average savings rate was 14%, and almost 2/3 of them were saving nearly 19%. It just automated the process and bypassed the psychological pain point. Genius.
Wow. Okay, so automate saving. What about the other side? Stopping the bleeding.
Yes, we have to recognize how small regular expenses add up over time due to that same compounding effect, but working against us. The Bottom-Otter example is classic.
That one always gets me $150 a month.
Yeah, maybe $150 a month on bottled water or fancy coffees or unused subscriptions. Seems small day to day, but that's $1,800 a year.
Okay.
Now, compound that $1,800 saved each year, invested at, say, 8% over a 40-year career. What do you get?
I'm afraid to ask.
Over $500,000, $500,000, gone. On tiny leaks we barely notice. We have to plug those holes.
Okay, message received on saving and compounding. What's the fourth pillar? Strategy.
Yes, the winning strategy itself. And it boils down to asset allocation and asymmetric risk-reward. This is how the really smart institutional money operates.
Let's start with asset allocation. David Swenson at Yale. He had some strong views on this.
Very strong. He grew Yale's endowment massively, from $1 billion to nearly $24 billion. He said investors really only have three tools: picking individual securities, market timing, and asset allocation.
And his conclusion was surprising, wasn't it, about which one mattered most?
Startling, really. He found that asset allocation, how you divide your money between different types of assets, like stocks, bonds, real estate, commodities, explains more than 100% of your investment returns over time.
More than 100%. How is that possible?
It sounds weird, but it makes sense. Because the other two activities, market timing, jumping in and out, and poor security selection, like picking high-fee bad funds, actually cost you money through fees, taxes, and bad decisions. They subtract from your returns.
So getting the allocation right is paramount, and then not messing it up with timing or bad picks.
Exactly. Asset allocation is the primary driver you control, which leads directly to Ray Dalio's warning.
Bridgewater founder, what does he say?
He says, bluntly, diversify or die. His point is, sometime in your investing lifetime, whatever asset class you love is going to lose 50% to 70% of its value. Could be stocks, bonds, real estate. Something will eventually get crushed temporarily.
It's not if, it's when.
Right. So the only defense is diversification, but not just owning different stocks. Diversify across asset classes, diversify across markets, domestic and international, and diversify across time, meaning investing regularly, dollar cost averaging, build an all-weather portfolio.
Okay, diversification protects the downside. Now, what about that asymmetric risk reward? That sounds like the secret sauce.
It really is the core strategy of the insiders, the pros like Dalio, Paul Tudor Jones, Warren Buffett. It means structuring your investment so the potential gain is massively larger than the potential loss.
Buffett's rules. Rule 1, don't lose money.
Rule 2, don't forget Rule 1. A focus is always on protecting the principal first. If you don't lose big, the upside tends to take care of itself over time.
The book uses Kyle Bass as an example, betting against the housing market.
Incredible story. He turned $30 million into $2 billion by shorting the subprime mortgage market before the 2008 crash. Sounds like a wild gamble, right?
It does.
But it was actually a calculated asymmetric bet. He found instruments where he was essentially risking about 3 cents to potentially make a full dollar if housing collapsed.
So tiny risk, huge potential reward.
Exactly. If he was wrong, he lost a small amount. If he was right, the payoff was enormous. That's asymmetry.
But okay, Kyle Bass used complex derivatives. How does someone listening, managing their own 401k or IRA, apply that concept? We can't exactly short mortgage bonds.
That's the critical question. For the average investor, asymmetry isn't about complex trades. It's about portfolio construction that inherently limits downside while capturing reasonable upside.
Like using index funds.
That's part of it. Low-cost index funds give you market average returns. You avoid the risk of picking a disastrous individual stock or fund. But true asymmetry in a personal portfolio also means including assets that tend to do well when stocks are doing poorly.
Like what? Bonds, gold.
Bonds are part of traditional diversification, yes. But things like gold, or perhaps Treasury inflation-protected securities, TIPS, can sometimes provide that asymmetric cushion during a major market crash. They might go up, or at least hold their value, when stocks plummet.
So it's about building a mix where not everything goes down at once.
Precisely. It protects your principal Buffett's Rule 1 without necessarily sacrificing all the long-term growth potential. It's achieved through thoughtful allocation, not fancy trading.
Got it. Okay, moving on. Takeaway number 5 is about speeding things up, getting to financial freedom faster.
Yeah, 5 specific accelerators to reach that point where your passive income covers your living expenses. Financial independence.
We've covered the first couple already, basically.
Right. Number 1 is save more, automate it, plug the leaks. Number 2 is earn more and invest the difference.
And the key to earning more isn't just working longer hours.
No, it's about increasing your value in the marketplace. Jim Rohn's philosophy. Don't wish it was easier, wish you were better. Focus on becoming indispensable, solving bigger problems.
Like Daniela in the book, who basically demanded double her salary.
Yeah. But she didn't just ask for it. She proposed taking on huge extra responsibilities and proving she could deliver massive value. She did, outperforming competitors so much that even paying her double saved the company money overall compared to alternative. She made her value undeniable.
Okay, so save more, earn more. What's accelerator 3?
Reduce fees and taxes. This is pure efficiency. Especially for higher earners, taxes can be the single biggest expense, maybe 50% combined federal and state.
So how you structure your investments matters hugely.
Immensely. Using tax-advantaged accounts like 401ks and Roth IRAs is obvious, but also understanding things like long-term capital gains tax.
Profits on investments held over a year.
Right. Tax at a much lower rate, maybe 20%, compared to ordinary income tax rates. Smart tax planning, keeping fees low. This alone can shave years, maybe 25% to 50% faster path to independence, just by keeping more of what you earn and grow.
Low-hanging fruit, really. What's number 4?
Get better returns, but not necessarily by taking wild risks in the stock market. It's more about looking at alternative investments, often things the wealthy have used for years that are becoming more accessible.
Like what?
The book mentions things like tapping into demographic trends, investing in senior housing REITs, for example. There's a massive wave of baby boomers needing senior living that's a predictable long-term demand.
A demographic inevitability.
Exactly. Or things like first trust deed lending.
Explain that briefly.
It's basically private lending where the loan is secured by real estate. It can offer higher interest rates, maybe 8–10%. But with the safety net of having collateral, it's a way to potentially get higher yields than traditional bonds without the same stock market volatility.
Interesting. Okay, and the final accelerator. This one sounds drastic.
Number 5, change your life and lifestyle. This is about geographic arbitrage, essentially.
Really?
Yeah, moving from a high-cost, high-tax state like California or New York to a lower-cost, lower-tax state like Idaho or South Carolina. It can instantly boost your savings rate by 10%, 20%, even 30%.
That's huge.
It's like giving yourself an immediate massive raise purely from cost of living differences. Can literally accelerate your financial freedom timeline by a decade or more. It's a big move, but incredibly impactful financially.
Food for thought there. Okay, takeaway 6 tackles a major fear for retirees.
Yeah.
Running out of money.
Yes, the sequence of returns risk. We touched on risk, but this one is unique and devastating for people nearing or in retirement.
Why is this sequence so important? Isn't it just the average return that matters?
Unfortunately, no. Not when you start withdrawing money. It's pure luck when bad market years hit relative to your retirement date. If you get hit with big losses in the first few years of retirement.
When you're starting to take money out.
Exactly. You're forced to sell assets at low prices to cover your expenses. This locks in those losses and cripples your portfolio's ability to recover when the market eventually turns up. A bad sequence early on can derail even a well-funded plan.
So how do you protect against that specific risk?
The book argues strongly for incorporating some form of guaranteed income. This leads to the discussion about annuities.
Okay, annuities. Advocated by the U.S. Treasury, experts like Dr. Jeffrey Brown, basically like expanding Social Security through private products.
That's the concept. You exchange a lump sum for a guaranteed stream of income for life from an insurance company. It removes the fear of outliving your savings.
Now, hang on. Annuities often get a bad rap, right? Complex, high fees, inflexible. Are we sure this is the answer for our listener who's already feeling overwhelmed?
That's a completely fair critique, and the book acknowledges the historical problems. The focus isn't on those old-school fee-laden variable annuities. It's specifically on newer structures, particularly the fixed-indexed annuity, FIA.
Okay, break down FIA simply. How does it work?
Think of it as trying to capture the best of both worlds, some market upside, but with complete downside protection. Your principal, your initial investment, is 100% protected by the insurance company. You cannot lose it, even if the market tanks.
Okay, that sounds good. How does it grow?
Your growth is linked to a stock market index, like the S&P 500, but usually with a cap. So if the S&P 500 goes up 20% in a year, you might only get, say, the first 8% of that gain because of the cap.
Ah, so you give up the huge potential gains.
That's the trade-off, yes. You limit your maximum upside. But, and this is crucial for sequence risk, if the S&P 500 goes down 20%, you lose nothing. You get 0% for that year. Your principal remains intact.
So it smooths out the ride, prevents those devastating losses early in retirement.
Exactly. It's designed specifically to combat that sequence of returns risk by guaranteeing no losses in down years. It's a tool for certainty, especially when income is the priority over maximum growth.
Makes sense. Okay, final takeaway. Number 7 brings us back to the why. defining the real price of your dreams.
Yes, pulling back from the mechanics to the purpose. The book argues many people chase a financial number that's way bigger than what they actually need for the life they desire.
Like that entrepreneur aiming for $1 billion.
Right. He wanted the jet, the fancy homes, the whole 9 yards. But when they actually calculated the ongoing cost to maintain that specific lifestyle, it wasn't $1 billion. It was closer to $10 million needed in an investment fund. Still a lot, but 99% less than his arbitrary target.
So the goal isn't the giant pile of cash itself.
It's the lifestyle the cash enables, and the feelings associated with that lifestyle: freedom, security, choice.
And often, the drive for massive wealth is tied to our basic human needs, right?
Yeah.
Like the need for significance.
Exactly. We all want to feel important, special, needed. It's fundamental.
But chasing significance by comparing yourself to others, that's a losing game.
It's a trap, because there's always someone richer, faster, younger, with a bigger house or boat. If your self-worth is tied to being better than, you'll never be satisfied.
So financial independence, having enough passive income to cover your life, that's winning the financial game. But it's not the ultimate win.
Not according to the book, and frankly, not according to wisdom traditions. The ultimate victory, the deepest fulfillment, comes from contribution, from making a difference beyond yourself.
Like Andrew Carnegie, all that steal money felt empty until he started giving it away, building libraries.
Exactly. He realized the money only gained meaning when used for others. It even inspired Rockefeller's philanthropy. And science backs this up now.
How so?
Studies consistently show that spending money on others makes people happier and for longer than spending it on themselves. Giving provides a lasting sense of fulfillment that buying more stuff just doesn't. The secret to living is giving. It satisfies that need for significance in a healthy way, detached from comparison.
Wow. Okay. A lot to absorb there. Let's try to wrap this up with some closing thoughts.
Sure, we've covered a lot of ground, from mindset to specific strategies.
It really feels like the path we've outlined, drawing from the book, it's like climbing your own personal Mount Everest, financially speaking. It takes grit, doesn't it?
It takes determination, definitely, faith in the process, and a real commitment to stop making excuses or accepting limiting beliefs. The knowledge is out there, like we've discussed, but the action has to come from you.
And to help with that action, the book suggests a practical tool, the V2MOM framework.
Yeah, used by Mark Benioff at Salesforce. It's designed to bring clarity and accountability to big goals. It forces you to answer 5 specific questions.
Okay, what are they? How can listeners use this?
You ask yourself,
What do I really want? That's your vision, the lifestyle, the feeling.
what's important about it? Your values, freedom, security, contribution.
How will I get it? The methods: saving, investing, allocating, the things we talked about.
Okay, vision, values, methods.
4. What's preventing me from having it? The obstacles: fear, fees, lack of focus, that internal story.
How will I know I'm successful? Your measurements: the specific freedom fund number, your savings rate, hitting passive income goals.
VMOM. It forces you to get really specific about the goal and the path.
Exactly. It moves financial freedom from a vague dream to a concrete plan. That clarity is step 1.
Okay, so get clear on the plan. Any final thought to leave people with? Something provocative.
Well, here's something optimistic, perhaps counterintuitive, that reinforces the idea that you can win this game. The future might actually be better and cheaper than we think.
How so?
Because of exponential technologies. Things like 3D printing, making goods cheaper, self-driving cars, potentially reducing transport costs, huge advances in energy, medicine, stem cells.
So the cost of a high quality of life might actually go down.
It's a real possibility, which means the amount of money you need to achieve that life of abundance, freedom, and choice might be significantly less than you currently imagine. It makes winning the financial game and shifting your focus to contribution even more achievable.
That's today's breakdown. While this discussion cannot replace the book's full text, it can offer a glimpse into its teachings. I hope you found this discussion helpful, and I look forward to sharing more. Let me know what book next you want to discuss.